This podcast is intended for investment professionals only. Hello and welcome to this month's episode of Market Talk. Despite it being Golden Week in China and Japan and preparations in full swing for the coronation of King Charles III here in the UK, economic data announcements and central bank actions carry on regardless. This week, we'll be dissecting the deluge of central bank meetings taking place this week and next in the US, UK, and continental Europe, discussing the ongoing concerns of the health of the financial sector, and asking, has the post-COVID recovery in China all but fizzled out? So, asking the questions is me, Francis Watson, here in the UK, and delivering them in his usual measured way, Ben Bennett, who joins us from Hong Kong. Ben, how are you?
I'm extremely well. Thank you very much, Francis. How are you?
I'm good. Thank you. So look, lots to get through as always, but should we just focus on the Fed and the Fed statement last night? A possible pause in interest rate hikes, but not an outright cut.
Yeah, it's really tricky for them. So they've got sticky inflation still. This is at the back of their mind, sticky inflation. But then they've also got other macro factors weighing on the growth outlook, I suppose, from this situation in the US banking sector, from what's also going on with the debt ceiling uncertainty, and just the lagged impact of their rate hikes that's been going on for a while. I mean, they don't really know how that's going to impact jobs, etc. So I think they've seen a little bit of a starting to decline on the jobs side. So it's not quite as roaring as it was before in terms of the job market in the US. So they're getting a little bit of hope there. They've seen headline inflation fall a bit. They've also got these things they're worried about. So they've decided, yeah, we're going to hike again. So they hiked by 25 basis points, but they dropped a line in the post-meeting statement, which basically said that they expect more hikes in the future. So they dropped that line. So they're no longer expecting hikes in the future. I think they still have a bias to hike. If everything just settles down, they probably would hike again, but they're giving themselves that flexibility to pause. So that's the potential pause.
And you mentioned that key phrase, didn't you? If everything settles down, because of course, in terms of US regional banks, everything hasn't settled down, has it? I mean, we've had the fall of First Republic earlier this week, and now PacWest coming out exploring a potential sale. Markets aren't terribly calm at the moment underneath it.
No, yeah, I mean, we spoke about this. I remember, after Credit Suisse had to be bailed out and Silicon Valley Bank, etc. And we said at the time that this is not the end of it, because the problem is if you force shareholders and bondholders to take losses as part of the resolution of these banks, then as shareholders or bondholders like ourselves, we're going to worry about, what's the next one that we're going to be forced to take losses on. We're going to be thinking quite nervously about that. We're going to be cautiously looking at our positions. And I think everyone's doing the same thing and looking at, okay, where's the next one that could fall? And of course, the cycle that we've got here is something that I think US authorities have got to take a good look at to try and break. At the minute, you've got a situation where depositors are nervous about share price falling, and then you've got assets at these banks, the bonds that they've bought in the past. These bonds have possibly fallen in value, and if they had to sell them now, if they had to realize those losses, then they would be staring at a bit of a hole in their balance sheet. But if you've got depositors leaving, then you do have to start trying to work out what your assets are worth. Then you create these holes, and then people like us, like I said, investors get worried about this. You get this sort of death spiral. The only way to try and stop this would be to either stop depositors leaving, so basically guarantee all deposits, not just up to a certain amount, but above that. They could also stop people shorting stocks in these banks. Maybe there are some speculators out there who are trying to sell these stocks to try and get the share price down, knowing that could lead ultimately to these banks having to be resolved. So they could stop that, or the Fed could come out with some sort of funding agreement where they could take these bonds off the bank's balance sheet and provide, better funding, basically value them at par, provide the funding for that. All sorts of stuff could happen. But until we do actually get this, that spiral just keeps going round and round. Banks keep on failing, pretty big ones as well. We've had 3 of the top 4 ever bankruptcies this year. Washington Mutual is the only other one in the top four, which happened, of course, back in the banking crisis. Lehman Brothers doesn't count as a bank under this definition, but 3 of the top 4 have happened this year. It's not a small thing. That's even inflation adjusted. So it's even accounting for
Yeah.
previous years. So it's a big thing going on here.
And I'm not sure markets have totally woken up to that. I mean, we are going to talk about resilience in equities later on, but should we just move on to the ECB meeting today then, Ben? Of course, Bank of England next week. And again, 25 basis points, a hike expected for both. So we've got macroeconomic uncertainty and central banks continuing to hike on the path to keep inflation down, which is, again, stubbornly high.
Yeah. So the European inflation, flash inflation was last week. It did come down a little bit, the core inflation, but still at 5.6%. UK inflation is higher than that, and that's a real concern. We know a couple of weeks ago that was much higher than expected. So both banks have got to keep hiking interest rates, absolutely. And I do think it's amazing in an alternate universe where inflation was under control, then I think that sort of concern in the banking sector would force or would encourage central banks to, if anything, cut interest rates, wouldn't they? But they're not. They're hiking. Okay, they're talking about pausing in the future, but they're still hiking. So it's incredible that they're also turning that screw. It's a really difficult situation.
So are we seeing any signs of this difficult situation and particularly tighter bank lending coming through into the Q1 results? We should be seeing some sort of patterns emerge now, shouldn't we?
Well, it's still a little bit earlier. I mean, we think the US economy is impacted by this, both by the credit tightening around these banks and also just more generally about higher interest rates just weighing on the economy. We think this second quarter, which is the quarter we're in right now, will be flattish growth in the US, and then it'll be negative in the third quarter. So we're not talking about negative growth yet. And of course, these results are for Q1. Q1 GDP in the US was still positive, small but positive. Companies broadly, on average, are able to pass on these higher prices to consumers. One of the big reasons why we got inflation, of course, passing on these prices, and also trying to keep their costs under control. So they're trying to keep real wages as low as possible. I mean, there's a battle there because, of course, the job market is so tight. So some companies can do that better than others. But broadly, these companies are able to hold on to profits. Profits in the US pretty flat compared to they were this time last year. So before we had any of these sort of volatile markets and concerns, Q1 2022 wasn't a terrible quarter for growth. So, we're talking about actually quite a resilient base, but that's to be expected. There's always a lag to these things, and we'd be expecting Q2, Q3, and then Q4 results to be worse. I think that's our trajectory.
Let's turn away from results to China now and the opening up post-COVID recovery. I'm reading a few mixed signals, Ben, about whether it's cooling off or whether demand, consumer demand is still picking up the pace. What's your take on it all?
Yeah, you mentioned Golden Week in China. So this is the Labour Week, Golden Week that's happening this week. And lots of people go on holiday, lots and lots of tourists in Hong Kong, for example. So we got some data there about domestic travel. It's 19% stronger, more domestic travel than it was even pre-pandemic. So even in 2019, so 90% higher than that. So there's been a real boost, and that's better than the previous holidays. Chinese New Year that we just had, Lunar New Year, which was still below 2019. Now this is above. So we're definitely seeing a recovery in things like domestic travel, restaurants, basically the service sector. But lots of other parts of the economy are still under pressure. The property sector. And we've had one of our analysts go over to China recently, and he's been looking at certain, property developer sites and sales. And he's saying, look, it's a broken market still. We've got state-owned enterprises that are doing fine. So the ones owned by China are doing okay because basically people trust them to deliver the property. But then the ones that are under pressure, the private owned or even the bankrupt ones, are really struggling to sell properties because people don't necessarily trust them to deliver the flat at the end of the day. So the property sector is still under pressure. Manufacturing sector is also under pressure because we know there's a slowdown globally. So there's fewer orders coming in from Europe, fewer orders coming in from the US as well. So it's a real sort of stop-start varied reopening. It's been a bit disappointing for the equity investors. There was a big increase, it wasn't there, in equity markets in China at the beginning of the year in January, and that's all faded. The Hang Seng is down, actually, when we're talking here on the close on the 3rd of May. It was actually down a little on the year. So it's really given up a lot of those positive gains with some disappointment. And the other place we're seeing some of that disappointment coming through, I think, is the oil price. Oil is one area of the world which has seen definite weakness. Down, Brent oil is down 15% this year, so it's down to levels that we haven't seen since the end of 2021. And I think part of that, again, is a little bit disappointment about the industrial demand from China. That's part of the equation here. So you can see it in certain markets, that breakdown between the consumer and the industrial side in China.
Okay, so against that background, and as you rightly say, the oil price, slowing down, reflecting of slower growth in China, US, etc. Bringing it all back to asset classes, then Ben, in terms of bonds and equities, any change in your thoughts about what you've been saying for the last couple of weeks? The bonds seem to be behaving as they should be, equities not so.
No, that's a good summary. It's exactly the same, and nothing's changed there. So the S&P has been pretty resilient. It's still up again to the 3rd of May, up 6.5% this year. So it's as if everything is going perfectly well. 6.5% is not bad, is it, for sort of 4 months? So equity markets are fine. Volatility is low. Yeah, and we just think that that's not accurately pricing in what is a significant risk going forward of a recession, with those other things that are ticking along from the banking sector and the debt ceiling as well as the other one.
I was going to come on to that actually, because looking ahead, and it is looking ahead. I think Treasury Secretary Janet Yellen saying that if they don't get the house in order, there could be a twin banking and government debt crisis if the debt ceiling isn't lifted by the 1st of June. So.
Yeah.
Is she right to say that?
So it's a complicated equation. Is US government finances? There is a possibility. I think this is what Janet Yellen is alluding to, that they run out of money without the debt ceiling being lifted on the 1st of June. They would probably skim running out of money, and then they would get some tax revenue straight away afterwards. So that they could run out of money for a day or two. I suspect they won't. But then they do have a bit more of a hard landing in July when they properly run out of money. That's almost certainly the X date, as people call it, when they will run out of money. At that point, they will have had to have reached an agreement between Biden and Congress to raise the debt ceiling. If they don't have that agreement in place, there's a possibility that they have to stop paying some government expenditure. I'm pretty sure they won't go proper Armageddon and stop paying Treasury notes, because that would have all sorts of repercussions, that would make the Lehman Brothers crisis seem like a walk in the park. So I don't think they'll do that, but they might start cutting back on what they're paying other government liabilities for a few days. And then they'll get the debt ceiling done, and then it'll be back to normal. But that's not great for sentiment. It's not great, even under that relatively calm outcome. It's not great, is it? And in the meantime, we've got the Armageddon scenario hanging over our heads as well. So all that's not going to help investment confidence, consumer confidence, jobs growth. So I'd say it's another mild negative for what is already a pretty strong headwind to US growth.
I just remember 2011 and what happened there. But then, as our economists pointed out, that did coincide with a full-blown Eurozone debt crisis. So
it's always a crisis.
Always a crisis somewhere. So look, hopefully not much of a crisis at the G7 meeting, which is coming up, I think, in Japan on the 19th of May. What are we looking for there, Ben?
Yeah, so it's just obviously the large 7 economies there. But the interesting thing I'm looking out for is whether that President Biden takes the opportunity to announce the pretty long-awaited China investment restrictions that people have been talking about for months now. But these are the planned US restrictions on US entities investing in certain sectors in China. We don't know what the exact plan is, what sectors are going to be targeted. But we might get something around that date, because Biden will have the opportunity to speak to other sort of key partners in the G7 and sort of get everything signed off. There maybe other countries would join him as well. So that for me is the key point about the G7 on the geopolitical side.
Okay, well, let's put sectors to one side now and bring up your number of the week. What number of the week are you targeting and why?
So I'm going back to doing a silly one here, but I'm using six because I'm checking out the timeline of the coronation on Saturday, and I think if I've got it right, I think King Charles arrives for the coronation at 6 p.m. Hong Kong time. So it's prime time Hong Kong time. So I'm going to get the bunting out, get a coronation quiche in the oven. I'm not very good at cooking, but we'll see what I can do.
Are you
And I'll be
making the
toasting.
tarragon and broad bean one, Ben?
No, of course I'm not. But
No?
I might have something similar, and I'll toast the coronation at prime time Hong Kong.
Fantastic. I'll be raising a glass too. All right, Ben, on that happy regal note, thanks so much for your thoughts this week, and thanks to you all for listening. Thank you. As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of legal and general investment management. Forward-looking statements are by their nature subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal and General Investment Management Asia Limited, the Licence Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.